First off, brother, how's Australia?
Oh, it's pretty nice. It's extremely
Yeah?
hot, way hotter than anything I've ever experienced in my life before. Like, I'm from Canada, so it doesn't get nearly this hot, but it's pretty sweet so far. I just arrived
Awesome.
2 days ago, so it's going pretty good. Definitely hard with trading. I don't know how you Australians do it. We do have a few Market Radar members that live in Australia, but the good thing is, like, at least in the mornings, I could still catch the last hour or two of market hours. So it's good with our strategy since we close in, do our position adjustments at the close. So I'm able to do that. But in terms of like being a full time trader, it must be difficult doing it from Australia with this time zone.
Yeah, I can only imagine. I mean, 16 hours ahead of Eastern Standard Time is pretty aggressive. But
Yeah.
let's talk about CPI coming in line this week, and then obviously markets love that.
Oh, yeah. It was a very bullish
Yeah,
day. Bonds
yeah.
completely reversed.
Ultimately, I think there's a lot of fear going on right now. I'm sure yeah, like bonds completely reversed, right? Because bonds were bidding up into it in case there was some type of um, downward surprise, I think, and that was completely unwound. And then, like, you can just see the fear in the markets now with even CPI coming in line. Everyone's worried. We had a hot PPI print Thursday, but I don't really put too much relevance on that. I think, again, CPI is ultimately PCs the gauge, but PCE runs very close off of what we're seeing, in CPI, PPI. So it should line up with what estimates are saying. So I don't think PC is going to really shock the market. Ultimately, CPI came in line. That's what's most important here. We're still under 3%. I think if you want to take like a vanilla approach to CPI, just bracket it out, break it down. Where are we now to where we've been historically? In 2018, we peaked at 2.9%. Headlines at 2.6 right now. We're still below the 2018 peak. In 2018, going into 2019, the Fed was cutting rates. They were easing, and the Fed was actually under 2%. This isn't saying the Fed is going to go under 2% now, because obviously neutral rates shift over time, and I think they're more um, they have more of a transition phase to them. They're not fixed. You're not going to just have the neutral rate higher or lower for indefinite periods of time. I think that kind of moves, but I mean, like you said, man, market takes it well. CPI is in line. Overall, this was a very bullish CPI print for the market.
Yeah. Like, I think the big concern leading into the CPI was, has the Fed remained too restrictive for too long, which is something that we've been preaching about, saying that the soft landing is impossible. And I think we're kind of getting proven wrong on that. It seems like we're not getting a complete reversal in CPI and going down into deflation territory or very aggressive disinflation, which that's what the market is scared of. And we're not seeing that. So, have we gotten a soft landing? That's the question. Well, at what point can we say the Fed did it and they established and achieved the soft landing?
Do you want my honest answer or do you want my knock on wood answer?
I want your honest answer.
You want my honest
Yeah.
answer? Yeah. Look, obviously, if the way the soft landing happened, it's real. And now some of you guys or anybody listening might be like, "Oh, well, you said soft landings aren't probable." And like, I want to emphasize that in the scope, if you analyze from the first point at which the Fed raised rates to their first cut, if you use that window as a soft landing, I think the Fed has achieved. We said this months ago too. Depending on when you look at it, the Fed is going to achieve the soft landing, right? The odds are very high the Fed is going to achieve the soft landing. And I think like there are some issues under the surface that we can't ignore, but for the context of what you want to put in a textbook, the Fed achieved a soft landing. Now the question is, do they ease into this relief policy enough to where they pull some pressure off of the labor market and prevent themselves from being in a situation where they over tighten and pretty much blow past the soft landing, right? I think that's the predicament that everybody wants to know right now.
All right, well, what's your knock on wood answer?
Well, the reason I am hesitant to be, so cheerful of celebrating a soft landing is it's one of those things when we all start celebrating it, it goes, the pie goes right in our face. So I almost don't want to jinx it.
Yeah. What we were preaching when we were preaching the whole impossible soft landing is the Fed is going to be too tight for too long. And now we're here. It's looking like a soft landing, and the Fed is still very tight. Don't you think there's
I think
still
that's,
some,
yeah,
like,
yeah.
couldn't there still be some policy lags that have not yet bled into the market that we could be seeing?
I,
Like, I know with real estate, that's one of the most lagging ones. That is probably still not fully bled into the market, and we are seeing real estate weaken continually still.
well, I think we have to look at it from a perspective of like, let's just look at payroll growth, right? Payroll growth on a non-seasonally adjusted basis year over year and the unemployment rate. So payroll growth has fallen below 1.5%. Basically, it's slowed beyond an increase of 1.5%. Typically, that's like a red flag, and then, or I should say, a yellow flag, and then a red flag is when we drop below 1%. So we're below the 1.5% mark, and that's something that we have to be cautious about because typically when the labor market starts decelerating like this in this fashion, it's like a train that's building momentum and it's harder and harder to stop until there's like a labor market washout. Maybe it's the unemployment. It doesn't mean the unemployment rate has to go back up to the last high or the prior cycle 2010 high, 2008 high. It just simply means labor gets blown out a bit. It could mean unemployment goes 4, 5, 6, 7%, much higher than where it is right now. And as you can tell based on the unemployment prints and the jobs reports, the unemployment rate's been slowly ticking up. It's had its drops along the way, but it's pretty clear as of what we're seeing that the job market's very unique right now, where people have jobs, but if they are to lose their job, they seem to be having a hard time finding another job. And we're seeing that with job openings coming down as well. It's almost like if you're entrenched in the workforce right now and you're positioned in a job, you're okay as long as you don't lose your job. But it's hard for you to find work if you are to lose your job because most companies are not hiring, or at least they're not hiring nearly at the pace that they were a year and a half, 2 years ago. So I think that that is probably where we are right now. The labor market slowed, but partially, not so much completely. And I think that's what we're seeing again. Payroll growth slowing. And I know some people will say, well, okay, payroll growth is at 1.4% year over year, but that's, including government jobs, which are vastly disproportionate to the private sector. There's way more government jobs being added than private sector jobs, and that's a whole dispersion there. And that's true. And we'll see how that progresses into the next administration. But ultimately, job growth as a whole is on a downtrend. Unemployment as a whole is on an uptrend. They're just not significant declines and significant accelerations in either of these that are really spooking the market to the point where you're going to start pricing in a recession. And
Yeah.
growth is still stable, so you're in this like, again, call it soft landing, call it whatever you want. The way I look at it across an entire economic cycle, right? Because if you analyze the soft landing, ultimately the soft landing is just a segment of the economic cycle. And think of the cycle as a wave, and the soft landing is just take the peak of a wave or the trough of a wave and extending it. So dragging it out to making it almost seem like it's you're going so slow it doesn't feel like you're going towards it. That's what the soft landing is. But ultimately, I think the economic cycle continues. The Fed is at a point now where they're inherently becoming more restrictive on a global basis, even cutting 25 basis points at a time. I mean, you're in Canada, right? Well, not right now, obviously. They just cut 50 basis points, right?
Yeah. Yeah, well, Canada's in
So,
a way worse spot. Their unemployment rate is much higher than in America.
right. So, like, you have the rest of the world on this basically on this cutting wave, and the United States is that we've been doing 25 basis points a meeting, at least what it seems. It looks like we're going to do that next week as well. But we already have this push and pull on the idea that the Fed needs to pause at some point. And I think that
Well,
unless we see payroll,
I think a pause is actually a bad move because right now, in my opinion, we are at this avenue where we are seeing the labor market slow like this. People are having hard time finding jobs, and that's typically the precursor. First, companies stop employing people. Then if growth drops further, that's when they start firing people. And so that's one avenue. But if growth is able to pick back up, these companies are going to start hiring people and start lowering that unemployment rate. Those are the two avenues, and it's highly growth dependent.
exactly. So now the question that remains is if growth is so this is the dilemma that the Fed has, right? And I guess everyone. If growth is resilient, right? But let's just say it is resilient in excess, meaning it's only resilient for so long, but it's resilient at the moment. The Fed may be forced into a position where they, well, not, I don't want to say the Fed. The Fed's never really forced. They can do whatever they want, but the Fed is into this position where they almost think that they can be a little bit more hawkish and they end up just overstaying their welcome in restrictive territory. That's a real risk, I think, that we've been seeing the entire Fed cycle, and it only gets worse here if inflation remains. It doesn't take much for inflation to go. Like, look, you can look in here in 2018, from June of 2018 to December of 2018, inflation went from 2.9% to 1.5%. It doesn't take much for inflation to go below 2%.
Yeah,
It's not
and
like
it can happen very quickly. But I think the
I mean,
Fed
look,
actually has the ability to play hawkish like that if this new administration is able to just ramp growth up like crazy, which I think that's what the market is expecting.
that's going to be an interesting dynamic because if the tariffs really do come into play, I don't know how much growth we're going to get. I have a feeling like we're going to get moderate growth. It depends on the deregulation, the speed. There's so many variables, but
Yeah.
it, it depends really how much growth is going to be unleashed into the economy by basically unburdening the restricted areas of the economy versus how much it's going to be negatively impacted by tariffs.
Yeah. And there's so many nuances and just unknowns that you really can't trade based off that at the end of the day. Like you can't try
No,
to
it's
predict
impossible.
that. You really just have
No.
to look at what's happening today, what the market expectations are today, and just ride the waves.
Speaking of market expectations, man, it's been a great week overall for risk assets, huh?
Yeah. Yeah. Bonds
Like,
got completely slapped. It's risk on. It's definitely risk on at the moment. We're even seeing safe stocks like utilities and healthcare taking a beating as well. So I think the
yeah, like
market is fully
XLU,
shifting.
yeah.
It's fully shifting to a full on risk on pricing at the moment this last week.
This last week for sure. I mean, XLU is almost at Momo now, interestingly enough.
Yeah.
Like, it really, like, go back 2 weeks, man, it was a different story. We were like, oh, well, it looks like XLU is about to run a breakout here and maybe start sucking in some capital into defensives again, but nope, back down to lows. And healthcare as well. I mean, there are some other issues. There are some other issues in healthcare. I think the whole United Healthcare situation wasn't great for the healthcare sector as a whole. But ultimately, that again, falling utilities back near their local lows, and
And we got consumer
Bitcoin.
discretionaries just completely going straight up as well. We got
Oh,
Bitcoin too, all pointing,
let's
they're all pointing towards risk on. Like consumer discretionary is a top performer in expansion.
yeah, yeah. And we are actually like, I don't want to jump the gun yet, but the battle right now is between inflation and stagflation.
Yeah.
And I don't know where we're going to end up. But obviously our members know where we are today. And if you're paying any amount of attention to the podcast, you can guess where we are right now. But I don't that there's a battle going on, and I'm not sure where she's going to settle out, but we're locked in right now, and we hope to stay there because I mean, it's there's no other way to say this. I love risk on. Risk on is the easiest and most fun way to make money in the market. You get to be long all the stuff that goes up exponentially or much faster than defensives, and it's just fun. New highs all the time. Everyone's cheering. Great time to be alive. Great time to be in the markets. That's what risk on is. Risk off is if you time risk off right, you tend to make money, but everyone else around you is complaining or miserable, and that's not fun.
Yeah, everyone's just in a bad mood during risk off.
Yeah,
It's not a good time.
yeah. I mean, Bitcoin's like struggling here to hold 100K, and it's honestly like it's one of these things where it's like this has held up so well, and you kind of need to see this blow through 100K at some point here. I don't know if it happens in the next week. Maybe we need FOMC to clear the headway, but this constant push above 100 and settle back below would fail. The more times we do that and we don't break above, opens the probability that like this becomes a short-term top. Now, our Bitcoin model is not gonna take any of this into account. We're sticking to the rules which are aligned or outlined in the model itself. So this is more relevant. This is just price action observation that we do need to break 100K and hold at some point here. We can't be flirting with this indefinitely.
Yeah. Yeah, it's definitely not the best sign struggling to break above 100K like this.
No, no. But ultimately, yeah, consumer discretionary stocks absolutely. I mean, talk about a parabolic move. What are we looking in the last 1 month, 8%, in the last 3 months, 22% in consumer discretionary. There is nothing recessionary about. I don't look. We could be in a soft landing. We could be in a slowdown. We were in a slowdown ultimately in the summertime, and we came out of it into the fall. But this is the furthest thing from a slowdown right now. I think there are some growth risks on the horizon, but as of right now, we have yet to reach we saw those risks in the summer. They abated. We had a full acceleration in growth and risk on probabilities. And we're in some questionable territory right now, but we're nowhere near a confirmed slowdown.
Yeah, we are in questionable territory, but I think if we do get a slowdown pivot and this growth doesn't materially accelerate higher, we've got a great dip to buy in utilities. So
Oh, that's another good
I wouldn't
point.
even
Yeah.
be upset if we did get a slowdown near here. Sell out of Nasdaq at the highs, buy into utilities at the lows, get into a slowdown pivot, ride utilities up. That sounds like second best case scenario. Best case scenario is we get a growth surge and the Nasdaq just keeps going vertical. That's best case scenario.
Yeah, I hear you. I mean, listen, that's a prime setup there of being able to manage two different situations, right? The one thing that we're not even interested in right now are bonds. Like these are irrelevant to us. If you're long bonds right now, you're not long because of market radar. Let me just put it
Yeah.
that way. Like
Yeah,
we
bonds need
don't
to be
want
at
bonds.
least bullish trend before we even touch them.
Yeah, right now these are just honestly, this just looks like a chop mess for me because as long as we're bearish trend, it's just it's gonna destroy. It's gonna burn capital. I think a lot of the old members, man. I think they kind of learned their lesson in 21 to 23, right? Like when bonds got destroyed and like theoretically bonds made this bottom here in 22 October and they started rising and like everyone started getting hyped on this train that bonds are going to run into 23, late 23 they're going to be so much higher, and they never went bullish trend and they just destroyed capital. And then eventually we got the unwind later in the end of 23, but even from end of 22 to mid 23 they were just such a headache. And I think that's the key here. Like when bonds are bearish trend, you do not want to touch them. They're just a headache. They're annoying. Like especially when risk assets like look, if you're getting chopped up in bonds and equities are going down, it's one thing. But if you're getting chopped up in bonds and equities are hitting all-time highs like every day, like that's maximum pain, to be honest.
Yeah, that does not feel good.
That does not feel good. But I think this will wrap up the podcast this week. FOMC next week, guys. So stay tuned. We got some interesting news coming out next week that could really move markets. Other than that, thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar or go to our website at www.marketradar.com.